Welcome to Topic 1, Introduction to Accounting, Part 2. So in the Part 2 video, what we're going to be discussing here are the elements of our financial statements, our balance sheet, our income statement, and our statement of changes in equity. So in this course, we are going to cover our four major financial statements, which is our income statement, our balance sheet, our statement of changes in equity, and our cash flow statement. But with our cash flow statement, we are going to leave that one until topic 6. So for the moment and for the first few topics, we're just going to be focusing on the first 3 financial statements that are listed there. An important note for you, in this section, we are going to be covering some really important definitions of accounting terms that you will need in this course. So you really need to make sure that you understand the accounting definition and also realise that that definition may be different from the general use of the word. There is a glossary of terms in your textbook, so you might find it really useful to refer to that glossary throughout the course. So please just don't make any assumptions that terms that you have been using in day-to-day life are going to be used the same way in this accounting course, because generally it won't be the case. So be very clear on your definitions. Starting off with our income statement. So this statement's all about profit, and that's normally what everyone wants to know about, is profit. I have a business, am I making profit? I invested in a company, are they making profit? So everyone wants to know about profit that's earned by the firm. So the income statement tells us all about that. So with profit, the way it's calculated is by matching income, also called revenue, which is our amounts that are earned by the business. So we can also think of them as inflows into the business. So we match our income with our expenses. So our expenses are amounts that we incur in order to earn our income. So we can also think of them as outflows from the business. So overall, to calculate profit, we take our income or our revenues and we subtract our expenses. Where our revenue is greater than our expenses, we've made a profit. Woohoo! Yes, we've got a profit. But unfortunately, we don't live in a perfect world, so we might have some cases where our expenses are outweighing our revenues, and where that happens, unfortunately, it means we're in a loss position. Okay, so it's just be aware that throughout this course, the figures you're calculating, we give you a profit calculation, but just be aware you may not always get a profit in that calculation. And if you perform the calculation and you end up with a negative number, it means the firm's made a loss. Okay, and that's fine, it happens. We've got two sides of the coin that we're dealing with here. So what is income? Typically, your income is going to include the revenue that's been earned by the business as part of its normal operations. So if your business exists to provide, say, marketing services, or maybe you exist to provide advertising services, the money that you make from selling those services, that forms your revenue, and you're earning that revenue every time you provide that service. Okay? Or alternatively, if you sell goods, then every time you sell a good, maybe it's fluffy bunnies, maybe it's basketballs, whatever the case is, every time you sell those goods, you're earning revenue, and that's your normal operation. Interest can also form part of our income as well, and also dividends that we receive on our investment. Okay? As a business, yes, you can have some investments and you can earn revenue through those investments. One thing to be aware of though is that with the term income, sometimes it's used by some authors of textbooks to mean profit, and sometimes it's used to mean revenue. Okay, so just be aware if you're looking at different textbooks, sometimes they use the terms a little bit differently. In this course, and in the assessment in this course, we will always make sure that the meaning is very clear to you. Okay? We will not be ambiguous, we will not be vague. We'll be very straight down the line, very clear, very direct for you. So in summary, just with our income statement, we have two elements. We have our income, we'll also call it our revenue, and we can just abbreviate that down to capital R. From there, we subtract our expenses, which we can abbreviate down to just a capital E, and that will give us profit. But as I said before, if your expense figure is greater than your revenue figure, you'll get a negative when you perform that calculation, and that just means we have a loss instead of a profit. But this calculation right here, this is one of your key calculations that you need to know for the first 6 topics of this course, so the financial accounting component. Okay, what you also really need to be aware of is that with our income statement, the two elements that go into it. So be aware that only revenues and only expenses appear in your income statement. Really crucial point, and it's really going to come into play with each topic that we move through in the first 6 topics of the course. Moving on now to the balance sheet. So our balance sheet consists of 3 items. We have our assets. Okay, we abbreviate all of these down to single letters, so capital A for assets. So the way we define our assets is that they're items of value to the business or items that are also owned by the business. So items of value to the business, another way of putting it, items owned by the business. Then we have our liabilities. So these are amounts that are owed by the business, so owed by us. As I said before, you're a business now. Whenever you're looking at this course, you are a business. So it's money we owe to someone else. That's a liability. And then we have our owner's equity. So our owner's equity is the owner's interest or the owner's value in our business. So in other words, it's money that we as a business owe to our owner. Some examples of assets for you. Items of value to the business can include things like cash. Okay, we all want plenty of cash, and we know cash is valuable to us as well. Inventory that we're going to sell, that's also an item of value, because obviously if we're going to sell it, it's going to make us some money. Then we have accounts receivables, which can also be called debtors. So an accounts receivable comes up when, as a business, we either sell a good or we perform a service, and we do those things on credit. So in accounting, when we say we're performing a service or selling a good on credit, it doesn't mean we whip out the customer's gotten out their credit card and they're paying it with a credit card. What it means is we have done the work, or we have given, or not given, provided the good to the customer, and they haven't paid us at the time. So it means we've invoiced them and we've put a due date on that invoice, and they'll pay us by that due date. So note as well with receivables, anything with the word receivable in it, it's always going to be an asset because it's receivable to us. We're going to receive something, receive money. That's a good thing. That's valuable to us. So item of value. Now we have items such as motor vehicles, we have equipment, we have furniture that also get used in our business. They all help us to make money. So we might need furniture for our office workers to sit on so that they can make phone calls to customers and bring money in. So they're items of value. So don't necessarily always think of a direct pathway. Think of, what is the item used for? Okay, so we use motor vehicles in our business. We use equipment. We use furniture. Okay, in our business. So they're items of value. Looking to liabilities now. So as we know with our liabilities, this is money we owe. Okay, we owe people or firms outside of our business. So they can include things like anything with a payable in it, like accounts payable. So an accounts payable is where we, as a business, we have purchased. Okay, we have purchased some goods, or perhaps someone has performed a service for us and we did not pay them at the time. We are the ones, as the business, that has received the invoice that we then have to pay, okay, at some point. Okay, say whatever the due date is on the invoice, whatever the case is. Okay, also insurance payable could be another example. Also note that where you see the words owing and accrued, they all mean the same thing. They all mean payable. Okay, so when you see the word payable, break it down. The word pay, we have to pay. Okay, it's just a more simple way of thinking about it. So now let's move on to the accounting equation. So this equation would have to be one of the most important things you're going to learn in this course. Super, super, super important. It's one of those things, if you're going to get a tattoo of this accounting equation, because you need to look at the back of your hand. Put it on your forehead so you see it when you look in the mirror, because it is critical in accounting. So the way the accounting equation comes about is we take our components of the balance sheet. So we take our assets, our liabilities, and our owner's equity, and what we've done is we've formed a mathematical equation. Okay, and it's known as the accounting equation. So it's going to be used a lot, and it's going to play a really, really important part when we hit topic 3 onwards. So our accounting equation, it does form the basis of the accounting system that is in use in its various forms today. Okay? And accounting itself has been around for a really long time, and this accounting equation is carried on through the centuries, really. So continuing on with our accounting equation, here's what it looks like. Assets equals liabilities plus owner's equity. So this is what your tattoo should be looking like, okay? Or at least write it out, a good 1,000 times just so you don't forget, because it is so important. So some things to note about this equation. It's always correct. So your assets must always equal your liabilities plus your owner's equity. So what this also means is that at any point in time, this must happen. Okay, your total assets should always equal the total of your liabilities plus your owner's equity. So it doesn't matter what point in time it is, pick a point, do the equation, it should equal out. If your accounting equation is not equaling out, you have an error. Okay, so something's gone wrong. Perhaps we've got a misclassification, maybe we've added in an extra 0, who knows what could have happened, but you can't go, oh, well, we're only $200 off, let's leave it. No, you have to go and find the source of the error. Because again, think with accounting information, its endpoint is to be communicated to users who are actually going to make a decision on it. And no one appreciates making a decision on dodgy information. So we've got to go find the problem if we've got one. But fingers crossed, with a bit of care, a bit of caution, everything's going to balance out from the word go anyway. So now we'll look briefly at how the equation's developed and then how it's expanded. What we can also do with this equation, and what we will be doing, and certainly what you'll be doing, is we're going to be analysing business transactions with this equation. That's why it's super important that you know this equation and understand how it operates. So then when you get to topic 3, you're going to be able to blitz all your transaction analysis, okay? And you'll get it every single time and everything's going to run smoothly for you. So in this course, just a point to note is you will not have to prepare any accounting entries. So you might have done accounting previously before you've done this course. And if so, you've probably done things like journal entries and ledgers and much more complicated things like that. Now, in this course, you won't have to do any of those things. All this course requires you to have is an informed user's perspective on accounting records. We're not actually going to get you to reconstruct and construct accounting records in full. So we're giving you snapshots so that you can understand what's going on. Say if someone gives you an income statement, you'll know exactly what it is and what it means. Same with the balance sheet. Now, if we refer to our balance sheet definitions from slide 8, so you may want to take a minute just to have a look at those, just refresh your memory. There's a lot of information coming your way. So the use of our accounting equation in accounting studies is dependent on the rule that in everything that we analyse, we always view it from the perspective of the business. So as I was saying before, business hat on. Individual, uni student hat, it comes off. Business hat must come on because it will make your life a lot easier throughout this course. So coming back to our equation, on one side of the equation we have is what the business owns, and that's our assets. On the other side of the equation is what the business owes. Okay, owes in what we're due to pay outside parties. With our money that we owe though, we can owe it to 2 different types of entities. So we can owe money to our owners, which forms our owner's equity, or we can owe it to our non-owners, so they form our liabilities. So our equation can be expanded into its normal form. So our assets equals liabilities plus owner's equity. So you can see on the left-hand side there, we have assets, which is what we own, and on the right-hand side of the equation there is what we owe. So it's grouped quite nicely there. With our accounting equation, the way we typically write it is A equals L plus OE. Or we can rearrange it to OE equals A minus L. So provided we know 2 of the 3 items, we can always calculate the third. All right, so have that confidence. As long as you know 2 of 3 things, you can get that third one. So here, some brief examples. if, for example, our assets equals $1,000 and liabilities equals $700, our owner's equity must be $300 because assets of $1,000 minus liabilities of $700 equals liabilities of $700, owner's equals $300. Excuse my tongue tightness. Also, if we say take liabilities of $200 and we have owner's equity of $600, then our assets must be $800. There's owner's equity, okay? Liabilities plus owner's equity, 600 plus 200 will give us our assets of 800. So in summary, in the balance sheet, we have assets. So we have assets on one side of the equation. We have our liabilities and our owner's equity, and they're on the other side of the equation. So remember, they're grouped quite nicely. You need to be able to identify which accounts are assets and which accounts are liabilities. Crucial. So crucial, you've got to be able to, because if you can't identify what's an asset and what's a liability, if you misclassify things, you can understate assets, or you might understate your liabilities, or you could overstate items, which is not good, because again, this information, we're going to communicate it to external parties and they're going to make decisions with it. So we want to make sure that it's all correct. So last part of our balance sheet now is owner's equity. So we already know that our owner's equity is what our business owes to the owner. So what sorts of things could be included in our owner's equity? So we'll have a look at these items here and they'll give you some idea of what constitutes owner's equity. So say our owners commence a business and they commence it by contributing startup funds. So when an owner brings funds and starts up a business, we call that capital. So that capital then becomes what the business owes the owner. Why do we start a business? Generally, because we want to make a profit. Okay? Unless you are super rich and you want to make a loss because you've got some tax issues that you need to try and keep down, generally most people start a business to make a profit because they want to live off that money. So if a profit's made by the business owes the profit to the owner. At the same time though, if the business makes a loss, that loss does belong to the owner as well. We don't just get to pick and choose and keep the nice stuff. You make a loss, that's on the owner's head as well. And lastly there, sometimes owners will withdraw funds, okay? But those funds are what's owed to them anyway by the business. And when that happens, we call that drawings. Okay? If we're, say, working with a company, or in the case of a company, they might be paid some funds that are owing to them from the business. Okay? And in that case, we call those dividends. So when we put those three items together, you can see that the owner's equity for a business, in other words, what the business owes the owner, consists of capital that's been contributed by the owner. We add on to that any profit that the business has made. We might have to subtract the loss. You'll have one or the other. Okay? You're either adding a profit or you're subtracting a loss. And then, last step, subtract drawings or dividends if you're working with a company. Okay? And then that will give you the amount of owner's equity, so the amount that that the business owes the owner. So now we move on to the order of preparation of our financial statements. Okay, there is a particular order that we do follow, and that's generally because certain items of information flow from one statement to the next. So the correct order for preparation is firstly the income statement, followed by the statement of changes in equity, followed by our balance sheet, and then lastly we do the cash flow statement. So if we have a look here, you can see here we have our income statement. Note we have revenue and expenses. They're the only two account types that are appearing on this financial statement, and they're the only two that should belong there. So no assets, no liabilities, no owner's equity goes into the income statement at all. So note at the bottom there that with our profit figure that we derive through our income statement is given to the owner in the statement of changes in equity. So you can see where the profit figure is. There's a line coming down from that, and that line is leading on now to our statement of changes in equity. So this one tells us all about what the business owes to the owner. So we start off with our opening capital. We add on net profit. So that's the net profit figure that has come from our income statement. From there, we subtract drawings. And after we've subtracted our drawings, we come to our ending capital balance. So with that final capital balance, that's then going to travel across and link in with our balance sheet. So here's our balance sheet. As you can see, we've got assets, we have liabilities, and owner's equity. Note here, no revenues, no expenses. So you can see under owner's equity, that capital amount, the $31,575, that has come from the statement of changes in equity. So a link between the two statements, and also this is why we prepare the statements in this order. Also note with this financial statement that our total assets at the bottom equals the total of your liabilities and your owner's equity. So that is also showing you your accounting equation is very much correct and standing true, which is what you want to see on this financial statement as well. If it's not equaling out, we have problems and we have to go and deal with those problems. Okay, because as I said, if it's not equaling out, then it means there's an error, and we don't want to give incorrect information to someone for them to make a decision on bad information. So in summary here, assets, liabilities, and owner's equity appear on the balance sheet only. Revenues and expenses appear on the income statement only. So be very clear on what account types belong on which financial statement. The link between the income statement and the balance sheet is that profit, which we calculate on our income statement, is transferred to owner's equity on the balance sheet. So while revenues and expenses never explicitly appear on our balance sheet, the profit resulting from revenue and expenses does appear. Okay, so that's the end of part 2. So next video, part 3, we're going to do some practical exercise.